Hi everyone, welcome to Swissquote's daily market talk. Now the major talking point of today is Nvidia, which once again defied the doomsayers and came with blowout quarterly results yesterday, a significant beat on sales expectations and a bigger forecast for the current quarterly sales. So bravo is all we can say to Nvidia at this point. A big fat bravo. Nvidia is amazing. That's all I can say. What we see is unusually amazing. Nvidia surpassed the sales expectations once again and announced total sales of $22 billion for the fourth quarter of last year. That's a 22% growth compared to the quarter before, and that's an eye-popping 265% growth compared to the same period last year. So their data center unit revenue alone hit $18 billion. That's more than what they made during the entirety of the previous quarter. Accelerated computing and generative AI have hit their tipping point, said the company's CEO. He also said that demand is surging worldwide across companies, industries, and nations, and we have no doubt about that. And the cherry on top of all this is that for the current quarter, Nvidia said that they will deliver $24 billion worth of sales. And given the track record of the past year, we must admit that, there is a stronger case for the company to deliver on its promise than otherwise. So bravo Nvidia, it has been another amazing earnings announcement. Now, of course, Nvidia jumped 10% in the after-hours trading as predicted by options positioning and will hit a fresh all-time high at the open today. This time, the idea that speculation is partly responsible for Nvidia's shine will be obviously still on the back of investors' minds, but investors must also admit that at least a part of the rise is well-funded and it is well-deserved. So there you go, ladies and gentlemen. A potential misstep from Nvidia that would hammer the AI rally has simply not come. What now? The rally will probably continue. Until when? Until a misstep, but that's not today. Now, of course, Nvidia will see challenges on its way up, that's for sure. First, the revenue growth will likely stabilize, and the euphoria regarding growth and growth expectations and perceptions will level out. Competition will come in, regulation will come in, and China could also be a drag regarding the side sales because China stood for around 20% of Nvidia's revenues last year, and their part of Nvidia's sales will fall below 10% due to export bans. But on the other hand, note that Nvidia is unlikely to be constrained by drying demand anytime soon. They will actually more likely be constrained by their own capacity to respond to this fast surging huge global demand, and that could actually make the future revenues finite. But this being said, keep in mind that the company managed to decrease its lead times for GPU orders from 8 to 11 months to just 3 to 4 months, indicating that there is still room for further growth peak for their sales. And it's also worth noting that, yes, the AI rally of today is somehow comparable to the dot-com bubble of 2000s, which ended in tears for many internet companies, yes. But during the dot-com bubble that preceded a massive internet crash, company valuations were getting ahead of their earnings. But what's different with AI today is that, companies' earnings are clearly getting ahead of their valuation. So yes, of course, some companies' valuations are extremely high right now, but overall, there is also a huge amount of investment that are concretely coming in right now, and that's something clearly beyond only speculation. So yes, Nasdaq futures are up by 1.5% at the time I'm shooting this video right now. So I think that it is going to be a good day. Now, in a rare occurrence, Nvidia saw the light from the Fed minutes yesterday because, yes, the Federal Reserve also released its latest meeting minutes yesterday, and the news were not necessarily enchanting for the Fed those. Yesterday's minutes show that, most Federal Reserve members are concerned more about moving quickly to cut the interest rates in the US than concerned about keeping the interest rate high for long. Now, interestingly, activity on Fed funds futures still gives more than 70% chance for an interest rate cut to happen in June this year. But any further evidence that we might see on the inflation front, that inflation is picking up momentum, could actually easily hammer that expectation, push it back toward the second half of the year, and make the Fed's job harder for what they call the last mile. Now, on a side note, Joe Biden announced that 150,000 student loan borrowers will have their debt forgiven for a total amount of 1.2 trillion US dollars. Good for them, but that's just one area where the US government spends big to keep the US economy strong and resilient as it is today, at least until November elections. Plus, while oil prices are upbeat, crude oil is trying to drill above that $78 per barrel level right now. That's a major Fibonacci resistance that distinguishes between the actual negative trend in oil prices and a medium-term bullish reversal, while US gasoline bulls are, coughing back to life after more than 6 months silence, and the higher gasoline prices should also show up in the next few inflation readings in the US. Therefore, we think that the federal policy easing may not go according to the plan, and that's not necessarily a good sign for the dovish expectation. So I'm not surprised that the Fed members won't rush toward the exit to, stop tightening the monetary policy. But I'm surprised that the US dollar bulls are hard to bring on board these days, because the US dollar index slipped below the 100-day moving average and below its year-to-date bullish channel base as well. The euro dollar cleared its 200-day moving average on the back of a softer US dollar and is now trading above the year-to-date descending channel as well. Cable looks upbeat above its 200-day moving average, whereas the Japanese yen, which was supposed to be the rising star of this year, remember, is pretty much the only major currency out there that doesn't see enough demand. The dollar yen is just above the 150 psychological level, despite a broad-based weakness that we see in the US dollar these days. Now, today, the Eurozone PMI numbers will give us an idea on the fragile health of the Euro area economies. While inflation in the Euro area is expected to have fallen 0.4% on a monthly basis, and core inflation is seen 0.9% lower on a monthly basis as well. So softer than expected inflation and gloomy PMI numbers in Europe could stall the Euro bulls in the area to beat the US dollar bulls, and fundamentals back a softer euro against the greenback than the contrary. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.